Good morning, everyone. Welcome to this year's Winter Outlook. Could we have the first slide, please, Lucy? Thank you. My name's Emily Tattard. I'm Senior Risk Manager here at Mitie Energy. I'm going to be taking you through today's speakers and today's session. We've seen unprecedented volatility and uncertainty already this year, so we're very much looking forward to taking a deeper look at what we can expect for this coming winter. Please submit any questions as we go along, and we'll be answering as many as possible at the end of this session. We'll be starting off with Damien Cox for 25 minutes, looking at the non-commodity overview for this coming winter. We'll then hand over to Papazachariou for the commodity overview. Unfortunately, we have had a last-minute change in the speakers, so it won't be Alan today. We will then close off with a half-an-hour panel discussion and answer any questions that you have. So, as I said, please do submit any questions as we go along. If we could get the next slide, please. Thank you. At this point, I'll hand over to Damien Cox to run through the non-commodity overview.
Thank you, Emily. Good morning, everybody. Yep, my name's Damien Cox. I'm one of the analysts who work in technical reporting, and technical reporting supports you by looking at developments in non-commodity costs, which we help to inform budgets to enable you to make good decisions about your energy spend. So this morning, what I wanted to do is, for those of you who are maybe new to non-commodity costs, or just like a refresher, is to take you through the background to non-commodity charging before looking at a more in-depth look at the different charges that make up a bill, and then we'll round off the session, or my session, by looking at a few developments concerning network reform. So if we can move on to the next slide, please, Lucy. That's great. Thank you very much. So this slide here shows the general trend in non-commodities over the past decade up until 2025. And you can see there that about 10 years ago, we were looking at delivery charges, so network costs, transmission, distribution, making up around about half of non-commodity charges of a bill, supported by the Renewables Obligation and Climate Change Levy as well. In 2014, the government introduced its electricity market reform, which introduced two new charges. That was the contracts for difference charge, which is now the government's preferred vehicle for the deployment of large-scale low-carbon generation, and also the capacity market, which guarantees security of supply during the peak winter months. Those charges are set to grow over time. You can see there that the contracts for difference has a broken line. That's because it's extremely responsive to movement in wholesale prices. And that's something that we'll discuss in greater detail a little further on in the presentation. The increase in wholesale energy costs has meant that the share of non-commodities is a little bit lower now. So depending on how you fixed or when you fixed your energy, we're now looking at a share of between 50 and 60% of fully delivered costs. And against this, the main drivers for developments in non-commodities, which was sort of reinforced yesterday by the government's strategy on net zero, include decarbonisation of the economy, so moving first towards a low carbon economy and then full decarbonisation by middle decade. of this century. Energy security is extremely important, as we know, and also regulatory reform. Ofgem regulates for all consumers and is very concerned to ensure fairness, but it also wants markets to operate efficiently. So those are the main drivers behind non-commodity charging. If we can move on to the next slide, please, Lucy. Thanks very much. So as I touched upon, just the slide just sets the scene really. So the basic premise for non-commodity charging is that you divide the scheme costs, whatever they may be, whether it's allowed revenue for networks, green support subsidies, wholesale prices for, you know, CFD, those kind of elements, by national demand, to work out what the unit rate is going to be. And as you can see there, we've listed a whole number of points which can interact different charges at different times. So we've got weather, energy efficiency, infrastructure constraints, etc. So moving on to the next slide, please, Lucy. This slide just shows you the general trend over the past decade in terms of energy consumption. So falling energy consumption basically means that there's a smaller charging base, which means that if the scheme costs are going to stay the same, if they're divided by a smaller charging base, then the unit rate is going to go up. What's particularly interesting here is you can see the effect of the pandemic, which we'll come on to in a moment. You can see there very low demand in 2020. We've estimated what we think demand is likely to look like for this year. So basically taking the recovery we saw in the first 2 quarters of this year and combining it with the last 2 quarters of 2019, just to give a sort of a rough sense of where we're heading in terms of recovery. So with that, let's talk about the recovery from the pandemic. So if we can move on, please, Lucy. So yeah, we're expecting non-commodity rates to fall as demand recovers, as the economy rebounds. So we already saw this year that Q2 was 11% higher compared to Q2 20. Not all the restrictions had lifted by the end of June, but certainly well on the way to recovery. And what does that mean for this winter? Well, we had a look at National Grid's winter outlook, see what they had to say, and found that they broadly expect demand this winter to be in line with what we saw in 2019. So we've got a transmission system load of about 47 gigawatts for this winter, and greater certainty about demand is really going to provide more certainty about non-commodities. So let's look at our first non-commodity. Oh, okay, so we're going to talk about Pursuance now, so we can move on, please, Lucy. That's great. Okay, so what we've got here is 6 months of Pursuance charging, comparing this winter 21, against winter 20, and the pre-COVID winter as well. Now, ordinarily, you would expect an increase in demand to have a downward effect on a Pursuance charge, because obviously we talked about scheme costs being divided by demand. Demand is certainly higher if you look at National Grid's forecast. There are a couple of flies in the ointment. The first is that we have to pay back 10 million of deferred COVID support scheme costs, which were a feature of last year, given that demand was so low and scheme costs were so high. Ofgem decided that it was going to cap the hourly Pursuance rate. And then we had an under recovery reported by National Grid earlier this year. So this was a 44 million pounds under recovery caused by an error. So there's a code modification which came into effect at the 1st of October, which apportions 33 million of that between the 1st of October and the 31st of March next year. So the remainder was sorted out in other ways. So risk to higher Pursuance charges. So, well, if demand is lower than normal, well, that's difficult to see that it's a case coming into the peak winter demand. So I don't really think that's going to be much of a driver. Weather and embedded generation, yeah, those could feature if we have high levels of wind generation, and National Grid has to constrain the network. So basically get wind generators to turn off in the north, and then get gas-fired generation to turn up elsewhere on the network. Also macroeconomic and COVID-19. However remote, there is still a possibility that we may go into a lockdown. I do stress that it's remote, or it does feel remote at this stage in time, but nevertheless it's something to be considered. And then infrastructure failure. So we have a cable called the Western Link. It's a high voltage cable which allows Scottish renewable generation to flow south. If that cable is out, then it causes a problem. So if we can move on to the next slide. Okay, so let's have a look at contracts for difference. So as I said, this is a non-commodity charge, which is really quite volatile. It responds to movements in the wholesale price. It's reconciled on a daily basis. But basically, as a high-level explanation, generators will get paid the difference between the strike price and the wholesale price if the wholesale price is lower than the strike price. If the strike price is lower than the wholesale price, which we have at the moment, then this means that generators start paying back. So you can see there in the chart on the right hand side that we had a very low contracts for difference interim levy rate for Q3, and that's outturning, or looks like it's going to outturn, about £2.50. We then had a before period adjustment to Q4 21. So this is the light green bar. So you can see it's gone from £6.50 all the way down to zero. So that means that there's no need for suppliers to pay into the scheme, because the wholesale price is lower than the strike price. So the generators are paying this back. You can see for Q1 22, we've got a charge there of £2. So very interesting to see how this non-commodity charge, which is for, as I said, deployment large scale low carbon generation, is really quite efficient, and it's really good to see the market responding, or the charge responding in this way. So if we move on, let's look at a few more non-commodity charges. So feed-in tariff rates, highly seasonal. 80% of the scheme is based on solar, so you've got an average load factor of 10% a year. Obviously much higher load factors in the summer than we have in the winter. Interesting to note the variability in the charges there. You can see Q2 20, we're up towards £10. Very sunny conditions and very low demand caused by the lockdown. Contrast that to where we were this year. Recovery in demand, but it wasn't much of a summer, so the scheme costs were a lot lower, and you can see there that we've sort of modeled the seasonality going forward. Something that's quite interesting point to note, given high wholesale market prices and supplier failures, there's something that sort of Offgem is taking note of, and obviously suppliers fail, they can't pay their scheme costs. So you can see there that we just highlighted this, that nearly £800,000 or over £750,000 is owed to this. So everybody talks about mutualisation in the Renewables Obligation scheme. You can have it in the feed-in tariff scheme as well. So that could lead to additional costs for consumers to pay going forward. So moving on. Okay, capacity market auction, obviously security of supply, very, very high on the agenda at the moment. So this, as I said, was one of the schemes introduced by EMR to safeguard security of supply during these peak winter months. We had the auction earlier on this year. A couple of points to note. First of all, the government increased the amount of capacity that it was auctioning to by 2.4 gigawatts, concerned about supply security. And also that auction attracted a record price, £45 a kilowatt a year. Most of it was paid by existing generators, so gas-fired plant as well. But you also had some demand side response and some unproven demand side response, winning contracts as well. And also, don't forget interconnectors. So we're connected with neighbouring markets on the continent, so France, Belgium, Germany, not Germany yet, Belgium, but we also got a new link with Norway as well. That's the NSL link. Don't think that this was actually picked up any contracts in this auction though, but that link will enable us to access cheap Norwegian hydropower. So that's good, and sort of always the decarbonisation. So what does the auction mean in terms of prices that we can expect to pay? So we move on to the next slide. We see that there is a much lower peak charge for this winter than last winter. So we're down to about £52 a megawatt hour from 122. So that's good news. But looking further forward, if we factor in the fact that there will be a number of old nuclear plants decommissioning, and the fact that we don't have any coal from beyond September 2024, that tightens margins, and that's a bullish price driver. So I think going forward, we can expect to pay higher capacity charges in the future. So it's worth noting that if you can respond flexibly, it's a volumetric charge. So if you can reduce your load, then yeah, it's going to pay you to do so. So let's have a look at some network charges. We can move forward. Okay, so transmission charges. So this is the Tenuous rate. So if you're half hourly, you're going to pay your triads based on the 3 half-hourly peaks during the winter. We've got a higher price this year for half-hourly, looking about £51.30 a kilowatt compared to £49.50 last year. So the half-hourly residual, which can make up 90% of the demand tariff in some zones, is higher as well. So it's 53.23. So that half-hourly residual, that's going to go probably from April 23 now under Offgem's network reforms, but we'll get to that in a minute. And if you're paying non-half-hourly, it's £6.50 up from £6. So higher charges. These are all regulated as part of National Grid's collecting its allowed revenue. So if we can move forward, please, Lucy. That's great. So Renewable Obligation. So this is, as I said, right back at the start, one of the oldest green support scheme costs that we pay. It's the largest green support scheme that we have in the GB markets. 35 gigawatts of capacity there, which is reflected by the size of the charge. It's £24.99, £25 per unit. So it's the largest, one of the largest components in non-commodities that we pay. Very simply calculated, it's the buyout price, which is set by Offgem in February, multiplied by the obligation level set by BEIS the previous autumn. So one times the other gives us £25. BEIS has published next year's obligation level slightly lower, 0.491 for GB, 0.193 for Northern Ireland. Again, highlighting the point here about supplier failures or risk of supplier failures and mutualisation. So £7 million identified by Offgem there. So we'll have greater detail on any mutualisation next month when Offgem publishes its figures. The mutualisation threshold has been reformed for the 21-22 year, which we're currently in, but this refers to the previous year, and that was set at 15.4. It's now 63 million, so that's 1% of the scheme costs, but it's for this year it's 15.4 million. So the likelihood is that we're going to have to pay some mutualisation costs as well. So mutualisation, for those of you who don't know, is where the costs are socialised. So everybody else basically has to pick up the tab for supplier failures. So if we can move on, please, Lucy. That's great. This is our last non-commodity charge before we start to look at Offgem's network reform. So this is the hydro levy. This is a support cost for the distribution systems in northern Scotland. Fairly low, or a small component of non-commodity charges, but it has increased principally because of the government's decision to incorporate the £27 million associated with the cross-subsidy scheme for Shetland. You can see there we listed a couple of other drivers there. So the increase in energy efficiency reduces the size of the charging base, the demand charging base. Also, growth in embedded generation as well, and COVID-19 demand suppression, and it's also index linked to inflation. I know we're using 1.3% for this year. It's applied retrospectively in July after in April. The final tariff is published in July. We'll get an idea of the scheme costs next year in March. If we can move on, let's talk about Offgem's reform. So I've got 3 slides to talk to you about. So we're looking at Tenuos, Duos and Pursuance. I know there is so much going on in terms of energy regulation and government policy, but I really just wanted to focus on this morning because it is so relevant, and we're looking at this on a daily basis. So you may be aware that there was a code review from Offgem called the Targeted Charging Review. So this looked at the fairness of transmission charging and distribution charging arrangements, and Offgem found that they weren't fair, so it enacted some reforms. Some of those reforms have already kicked in earlier on this year. Some will take place in April. But what we're concerned about on this slide is the reform to the transmission demand residual. So if you remember, we said that the demand residual can make up to 90% of the demand tariff in some zones for your triads. Now that's going to go. That's going to go to be replaced by a fixed daily capacity charge. So what that means is if you were doing triad avoidance, you won't be able to do that any longer because you'll have to pay this fixed daily capacity charge. Now there's a lot of work going on in the background between Offgem and National Grid and in the industry on determining how this is going to work in the end. It's pretty much all there. It's been consulted on, but the timetabling this year meant that in the end Offgem didn't think it was going to be able to get everything done in time for implementation in April, so it decided to move implementation back a year to April 23. So what that means is if you're able to avoid triad charges, you can do so for another winter. It only affects the transmission demand residual. So the Duos residual, that's going to change. So that's again, that makes it unavoidable to load shed really. So what it does is it changes some of the time of use tariffs, but it lowers them, but that's offset massively by a new capacity charge. Again, you can't avoid it. So Offgem is introducing this because, as I said, it regulates for all consumers. Rightly or wrongly, that's what it's doing for. Offgem is also considering launching a consultation in the future on further reform to transmission. So it's launched a call for evidence at the start of October. So what it wants to know is further reform necessary, and what parts of transmission charging would need to be prioritised. So there are issues around small distributed generators, those generators who capacity are less than 100 megawatts, who don't pay transmission charges. So that is part of a separate but closely linked code review called the Access and Forward-Looking Charges Review, which is what we're going to talk about next. So if we can move on, please, Lucy. So this is all part and parcel of reform of dual charging arrangements. So the access review looks at slightly different elements of the tariff structure. So this is really concerned about how people can access networks in the first place and the access rights that govern those. And Offgem wants to adapt these to become more flexible, given that we're making a transition towards low carbon economy. New technology means that people can do things in a different way. It frees up capacity on the network. If it frees up capacity on the network, it means that people don't have to, or the networks don't have to spend money reinforcing those networks, or investing in capacity that providing additional capacity that isn't really needed if you can free up the existing capacity. So this is what the access and forward-looking charges review is all about. So it's looking at three elements. So the first one was changing how much people pay for connecting to the network in the first place. So if you had a new site and you wanted it connected, but in the course of connecting it, it means that the network operator has to reconfigure the network and reinforce it, then you previously would have had to pay a contribution towards that. Offgem wants to remove that. It doesn't think it's right, and it's basically acting as an impediment or a barrier to electrification and moving towards net zero. So consultation response was run over the summer. It's analysing responses at the moment. Found there was good support for that. Support for our changing access rights. So we talked about that just a moment ago. So as I said, that's all about creating flexibility. And then this final one, there's very strong support for wide-ranging review of transmission charging for SDG. So Offgem is really concerned about this because the amount of SDG has grown over the years. It's like 24 gigawatts of capacity now, and it basically thinks that the transmission charging arrangements are not fit for purpose, and it wants to reform this, but it understands that this is a really contentious issue. So it's going to, probably look at introducing this in a gradual way, but basically he wants SDGs to pay transmission charges, and we expect a final decision on this by the spring, ahead of implementation in 2023. And then there could be a further set of reforms beyond April 23. Again, this is all part and parcel of the transition to net zero and taking advantage of system flexibility. So yeah, watch out, there could be some further consultation. But before then, let's move on to our final slide concerning network reform, and this is all part and parcel of Pursuance. So remember we talked about Pursuance a little while ago, about the costs associated with it. Offgem is looking to reform charging arrangements here. Now this is, well, there's no way getting away from it. You know, we're going to have to pay a little bit more. So basically, Pursuance is paid by all network users, so generators and suppliers. Offgem doesn't want generators to pay any more. He wants them to align with markets on the continent. So part and parcel of that is to exclude them from paying Pursuance, which means that everybody else will have to pay. Offgem says that it'll add, or the modelling that was done for Offgem says this will increase Pursuance by an average of £3 a megawatt hour. Across the day, there's going to be sort of a minimum price of around £2, I guess, during daylight hours when demand is higher, and then up to £7 during the middle of the night when demand is lower. But it's countering that by saying that wholesale prices would be expected to be lower as a response. But when I think about this, I think, well, that's cold comfort, because our wholesale prices are, you know, through the roof at the moment. You have to look at the trend in day ahead prices since the start of October, you know, to see that. So anyway, that's part and parcel of the reform. That's what it wants to do. There is going to be a consultation expected in the near future. So this is an opportunity for people to use their voices and say, no, we're not happy with this, or yes, we think it's a good idea. Implementation of all reforms would be expected in 2023. So there is going to be a consultation. So that's it's an opportunity for people to respond and state their case. And if we can just look at the last slide before we close. So this is managing non-commodities risk. We'll always put this in sort of common sense, really. Our non-commodity charges are volumetric, pounds per megawatt hour. So if you can reduce your energy consumption, then you're going to consume less energy and pay less as well. You may already be doing this, or you may not actually be eligible, but you could consider exemption from certain schemes if possible, although I would imagine that if you are able to, you will be doing it anyway. And the same for the capacity market, as you said, demand side response picked up, was it 8%? In the auction in March. So that's, you're getting paid for being interrupted rather than, you know, sort of being interrupted and, you know, being outside the scheme and not getting paid. So again, I'd imagine that if you're able to do so, that you already have looked into this. And then just generally, you know, we're all operating in the energy space, and it's just good practice, good habit to get into is to look at developments on a daily or a weekly basis, or get somebody else to, like us. We produce the energy policy report, which comes out on a monthly basis, which we include developments in there and stats on non-commodity charges, and monitor changes in future energy policy. Obviously, net zero is extremely important, and that's part of our business, is to help guide you through that, trying to make, you know, your journey to net zero as easily as possible. Right, that's pretty much it from me. So thank you very much for listening. There'll be opportunity for questions a bit later on, but in the meantime, thank you very much, and bye for now.
Thank you, Damien. Thank you very much. That was very insightful. As Damien mentioned, just a reminder that there is the question box, which is at the bottom of your screen. We're now moving over to take a look at the commodity overview, and as mentioned at the top of the webinar, this will be taken by Anas. Over to you.
Thank you, Emily. Thank you very much. Good morning, everyone. I'm Anas Papazachariou. I'm a senior PPA structuring manager for Mitie Energy. I'll be taking over the commodity presentation from Alan today. So we will be focusing on today's tight energy market, basically, and why gas and power prices have been increasing considerably over the last few months. We will see a brief outlook of the UK gas power supply and demand this winter, and what we kind of expect in the wholesale price market developments over the next few months as well. If you can move to next slide, Lucy, thank you. Next slide, please, as well. So it is important to just kind of take a step back when we're talking about power markets and gas markets. We're talking about different contracts to kind of understand what exactly we're talking about and make a distinguishment between the near term and the long term. What we have seen this year, specifically over the last 6 months, is that the near term has been mainly driving the markets higher. And when we're talking about near term, we're talking about the day ahead prices, the front month prices, November 21 for the current front month, the quarter ahead as well. So these markets are mainly driven by seasonality, they're driven by weather developments, the power and gas supply demand market, how much renewable generation we have, anything around plant maintenance, the carbon options, the LNG import. So everything that happens in the near term, everything that happens that can change and can bring the market back to an equilibrium, and that's kind of creating distortion into the near-term markets. Now, when we're talking about longer dated contracts, however, we are talking about the bigger picture. We're talking about developments in policy, as Damien was talking about earlier. We're talking about geopolitical risk, economic outlook, decarbonization plans, anything around what we will expect to happen in the market over the next 2 to 3 years. There is, of course, a connection between near term and long term, and that connection is very important. We have seen, of course, the front season contract, summer 22 at the moment, trading very close in the power market at 120, 150, 120 pounds per megawatt hour. And of course, we don't usually expect summer prices to trade that high. The main reason that happens is because the near term is very tight at the moment, and we do expect to have some sort of premium in the front season just because we are ahead of the winter period, and we need to kind of wait and see what the situation will be after the winter period ends in March. Yeah, that was just basically an overview of what we're talking about when we're saying near term and long term, what affects each of the two elements. Next slide, please. So we'll start with the gas, with a kind of overview of gas and power prices. We're looking at day-ahead charts here for GB power in pounds per megawatt hour and GB gas in p per therm. We have actually took the chart back to October 20 until October 21. Of course, everyone remembers what we have seen in the market throughout 2020, very low gas and power prices because of the impact of COVID-19. There was a very strong bounce back within the period July to January, technically to December for 2020, mainly because the markets have started seeing an economic recovery, but also because carbon prices have increased considerably within 2020. Now, within 2021, the day-ahead prices have been impacted a lot by, as I said, near-term development, seasonality, weather. The weather has been very cold since pretty much May 2021. And the day-ahead prices increased from April to August by 250%, with forward prices increasing by roughly 200% within the same period. Now, last winter we came up out of a very cold winter, as I said. May has been really cold still, and storage gas side has actually depleted significantly. That created additional demand within the summer period, and through a number of other reasons that we will see a bit later in the presentation, we have seen, of course, that the day-ahead market, the month ahead as well, that we'll see on the next slide, has been significantly increased. Now, it's very important to focus on the volatility that we have seen, specifically in the GB power market and the GB gas market within September and October. And you can see, of course, from the chart, a very significant spike in the day-ahead prices. That volatility came basically because of uncertainty in the market, and because of the balancing mechanism that are actually quite currently in place in the GB market. We've seen prices rising to £3,000 megawatt hour in the balancing market, even before the very cold winter months that we are expected to come. So we will focus on all these in today's presentation. It will be slightly different to what we've done in the previous two outlooks, because of course we've seen mainly and we focused mainly on carbon pricing and the long-term outlook. However, it was only necessary this time to actually focus on what is happening now, see the balances in the market and what we expect to be as a risk in the next few months. Next slide, please. So we don't need to stay too long on this slide, but looking on the front month, we can see, of course, less volatility because the day-ahead prices are impacted by the balancing of the market, as we said earlier. But of course, starting again from 2020, we've seen gas and energy production curtailed due to COVID-19 and hurricanes around that time. We also had very strong plant maintenance postponed to summer 21. And of course, as we move towards 2021, from April to May, around the same time, we can see, of course, that we had unusual cold weather during April and May, and that actually created a depletion of storage across the northern hemisphere. So that was the main reason we started seeing an increase in gas prices, and then from that point onwards, we have started seeing a very significant increase in gas demand and power demand in Asia Pacific markets because of economic recovery as well from COVID-19. But we pretty much saw Asian markets absorbing a lot of different energy and commodities all across the globe, and that actually increased the whole complex, the whole energy complex. And now focusing again on September and October, we had, of course, a lot of uncertainty around Russian imports to Europe. Everyone has probably read somewhere in the press around about the Nord Stream 2 pipeline, when this pipeline is going to come online, what is happening on that aspect. So we have to kind of see and focus a bit more on how much of this increase is actually an actual market tightness, and how much of this increase is a risk or a degree of panic, basically, because of what we expect to happen during this winter. Next slide, please. So just to summarize what we've seen in 2021, very cold temperatures in January, April, and May in 2021, which actually decreased storage size, which brought an additional increase in demand during the gas demand during the summer period in order to fill up our storage sites again. That happened across Europe. We also have very low wind generation. Of course, with renewable generation, if the wind doesn't blow, we don't get the power production that we want to have and we expect to have compared to the normal. That has kind of continued until September, and it actually made things a bit worse in the power market. We also had Russian exports to Western Europe dropping significantly. We have seen nominations for Russian flows through Ukraine in November being very low as well, which kind of added to the premium that we have. And of course, as I said, China, India, and coal demand increased significantly. So the whole energy complex have seen a very significant increase over the last few months. Next slide, please. So we're focusing on the power fundamentals to start with. It's always important around that time to consider what National Grid says in terms of how the power generation outlook will be this winter. So we have a technical capability of around 105, 110 gigawatts. If we look on the derated generation capacity, which actually takes into account the load factors and the losses, thermal losses in the production, and compare that figure against the average cold spell peak underlying demand, we have a derated margin, which is basically a derated kind of spread of 3.9 gigawatts, which is 6.6% representing the average cold spell peak underlying demand, basically. That number is slightly lower from last winter, where we had an 8.3%. However, National Grid has said that there is enough generation capacity to keep the lights on this winter. There are balancing mechanisms in place that can help with any potential tightness in the system, including the liquidity margin notice and the capacity market notice, which Damien talked about earlier slightly. But it is important to understand that these mechanisms balance the near term and keep the lights on. But in order to bring these balancing measures in, we will need to actually increase spot prices, and this will increase volatility and, of course, keep the markets higher if the system is tight. So moving on to the next slide, we'll basically see a bit more on the daily balances that National Grid produces. So this is basically daily overview of what we expect from 1st of November to the end of March. As normal, we do expect half of this mid-December and until mid-January to have probably the big demand within the winter, and of course during the Christmas time we see demand dropping significantly. I think it's important to keep from this slide that if we assume the generation will have low imports associated from Europe, which is not something that we usually see for the UK, to be honest, we will have a fairly tight market around January. Now, taking into account the average cold spell demand and reserve requirement plus exports to Ireland, which I think this is probably a more realistic scenario, if I may say, we have to actually look mainly on the purple line to understand how much purple line against the dotted red line to understand how much our system will be tight basically this winter. And we have times within December and January that it's likely to require these kind of notices that we expected, that we discussed in the previous slide. However, as we said, National Grid expect the system demand to be filled at all times, but we have seen that there is slight volatility in the market over the last few years, and we do expect for the same to happen this winter. Next slide, please. Now, we briefly touched on imports in the previous slide. We expect last year's import volumes from power pipelines to be exceeded this year. That is mainly because we had another pipeline coming online, the North Sea link for Norway. That is a 1.4 gigawatt pipeline, which has started flowing basically, but on a reduced capacity. We do expect capacity to increase in November, probably early December. That actually is a very important pipeline because it brings mainly renewable energy from Norway to the UK. We expect that pipeline to flow most of the time towards the UK, just because of the spread between the prices of the UK market and Norwegian markets. Now, it's very important to understand that power pipelines are very quick to sift in terms of demand. So we do expect volumes to be sifted in terms of peak day versus a windy day. So depending on how much renewable energy we have in the system, we'll either require less or more imports during the day. The impacts that we kind of see for pipeline flows are the French nuclear market, which is something that we discuss most of the times. It's almost every year. We don't see a significant risk from the French nuclear power plants this year. Maintenance has been undergoing in 2021. So we don't really see any significant risk coming from the French market this year. Of course, Norwegian hydro, German coal generation, and wind in Ireland are all playing a part in terms of how much power will flow towards the UK and how much power will flow outside of the UK. But the North Sea link is something to keep this year, just because it's expected to bring something, bring more power in the UK, especially after the IFA1 fire. The pipeline between UK and France, which will actually keep part of this route offline for the next few months. Next slide, please. Now, electricity peaks is still a concern. I think it's probably the point where we kind of want to try and understand what National Grid can do to actually meet demand. It's not a matter of whether it can meet demand 1 or 2 days of cold. It's whether the system can actually be met if we have a very prolonged cold spell, similar to what we've seen in 2020 and 2018 with the Beast from the East. but there are some uncertainties which are going to be carried across over the next few years about the speed of electrification. Is it underestimated? How much we expect that to affect the system, basically. But of course, we do have different mechanisms in place at the moment, including demand side response, energy efficiency, to actually mitigate similar risks. We do, of course, expect the 2021 peak demand to increase compared to 2020, 2021, just because we have a recovery in the economy, and we don't really see a significant risk or disruption from the demand side this year. Next slide, please. Yeah, next slide again. So talking about the gas market, of course, a very significant subject this year. Gas has been driving power markets, the power prices over the last few months. Similar to the power element, National Grid expects that gas supplies to customers will be maintained this season, despite the global shortage that we've seen, and an increase in demand globally as well. We have a diverse sources of supply from the UK continental shelf and Norwegian continental shelf, Belgium, Netherlands, LNG, and storage. Storage has actually increased considerably over the last few months, from July, where we was 23% full, to almost 94% full at the moment, which is very good for the time being. We usually see storage sites starting to export around January time, mainly in Q1 22, where we see the colder winter. So if we don't see cold winter within this quarter, Q4 21, then we usually have a normal kind of export rate from storage. The maximum supply capability is roughly comparable to last winter. Nothing changed around that. But we have to consider that the prices that we actually need to pay to compete with the global markets are much higher compared to what we've seen in previous years, just because of the tightness we've seen throughout 2021, and because of the premium added ahead of the winter period. National Grid has a range of tools to balance the market, and as we said, there are different routes to follow there. Next slide, please. So I think it's important here to kind of see where the capacity, the peak supply capacity is being drawn compared to last year. We think that this extreme scenario of 609 million cubic meters per day presented by National Grid is almost impossible on that aspect. And alongside that, the corresponding demand at 505 million cubic meters per day is also unlikely. We picked that somewhere around 400 to 450 million cubic meters, similar to what we've seen in a bit from this scenario. But I think the main question here is to understand, again, it's not the one day within winter or the 1 or 2 days within winter, is how much of a sustained period of cold weather will result in 400 MCM demand for an extended period, as we've seen in 2016. Are we able to meet that demand if that is prolonged? And if we move to the next slide, I think we kind of set some light in this question. National Grid says that we can meet the cold day demand. It's more to understand what will actually help in terms of the different sources in order to meet a prolonged period. And of course, we know that UK production, Norwegian imports are dropping over the last few years. We have been more relying on LNG imports and interconnected imports as well. And of course, we have mid-range storage. And if we move to the next slide, again, the LNG imports are almost the most important part of flexibility that we've seen. This is a very nice chart, actually. It basically shows from 2017 to 2021 how the historical monthly energy sent out volumes have been played out. And of course, we've seen record highs in terms of export volumes in 2020. Quite high volumes in 2019 as well. 2020 initially, and then because of the pandemic, we have seen a significant drop. But in 2021, because of the high demand that we've seen in Asia Pacific markets, and because of a global shortage in general, we have seen that we have been receiving 2 to 3 cargoes per month from July to September. We don't really need usually a significant amount of imports within the summer period. We usually see imports dropping in the summer period anyway, because there is a high demand in Asia Pacific for cooling. However, because of this kind of slow rate is actually a point of concern, just because we do compete with global markets for energy cargoes. We need to pay more, as we did this year. And we have seen a step change in November, December 2019 levels recently. So it is important to note here that if we don't have the flexibility from LNG, our markets will be much tighter, and we will only get this flexibility from LNG if we actually pay the price that we need to pay to actually get the cargo from other markets. So this is actually what is probably going to bring a lot of volatility and likely to bring high prices if Asian LNG markets are equally tight and if there's not enough LNG cargoes in the market. Next slide, please. Now, in terms of summarizing what we have seen, National Grid state that there is sufficient power generation available to meet peak demand. National Grid has the tools to meet demand and create a larger buffer if needed. But as Mitie Energy, we do have concerns about low wind coupled with with cold conditions, and that will be the point what would test resilience in the system, basically. Now, in terms of the gas market, there will be sufficient gas available in supply and demand scenarios, and all supply and demand scenarios. We will have a diverse source, but it's likely that we need to pay more to actually secure these cargoes. And of course, it would really depend on the weather and any outages we might see this winter on how tight the system will be. We are, of course, and it's very significant to understand that we are on the peak of the market just ahead of the start of the winter period, and we usually see increases in winter. That is likely to affect the summer prices as well, because it really depends how much of a risk premium we have within the winter period to drag that into the summer. The market in general, if we see longer dated contracts, is actually backwardated, which means that we do have a significant risk in the near term, but as we move out, the market follows again a bit more into the carbon prices, currency, and economic outlook as well as normal. Next slide, please. Now we're going to see a few slides on the outlook here. Again, it's something that we discussed a bit earlier, but if we do have a prolonged cold with supply issues, this could result in prices exceeding previous highs. We see that number close to 300p per therm in Q1 22. If we do have a similar situation to what we've seen in early 2021, with very cold weather, storage size dropping significantly, and Asian demand getting a lot of LNG actually from the European markets. Now, on the opposite scenario, if we have a mild winter similar to what we've seen in 2018-19, with a lot of LNG being able to compete in the markets, get the LNG cargoes in, and Russian flows start to increase, initially through Ukraine and on the second stage through the Nord Stream 2, which we do expect to come online probably towards the end of the year or start of the next one. We do expect to see a drop, but not a significant drop. We do expect markets to trade on a very wide range of 100 to 180p per therm, just because there will be still a risk premium added. The market is quite tight at the moment, so it's quite difficult to actually change this kind of situation in just a few months. Next slide, please. And then if we look on the power price, again, similar, there's a similar kind of comments. It really depends on the gas prices. Power has been falling gas on almost 100% correlation alongside coal and of course wind generation in the near term. So 300 pounds per megawatt hour is a number that we could potentially see on the day-ahead market again. And in in the front month, but then day-ahead prices could actually rise even more significantly, similar to what we've seen in 3,000 pounds per megawatt hour, because of the balancing of the system. Now, in the opposite scenario of a warm and windy weather, and good plant availability across Europe, France specifically as well, and low gas prices in the scenario that we've seen before, we do expect prices to start falling. Probably we'll see prices in Q1 22 dropping below 150 pounds megawatt hour if storage sites remain relatively full just before the summer period. We will expect to see the front season summer 22 drop also, and then of course that will be actually depicted in the day-ahead market prices and the month ahead prices within the summer period as well. Next slide, please. And then one final slide to talk about the carbon market, of course, development zone from the COP26, which is expected to start. In previous seasons, as we said, we have focused significantly in carbon pricing, and because carbon has been the main driver for power and gas sentiment, specifically in 2020. This year, we thought it was very important to actually focus on the near term, discuss about the near term and what are the risks, but carbon still remains there, and it is still a very significant factor. Now, we have seen a decoupling between gas and power markets and carbon just because of the risk in the near term. But of course, we do see carbon affecting fuel switching. Initially, we have seen coal and lignite coming back into the energy mix in Europe mainly. We have seen switching levels with gas increasing and having a larger gap because gas prices have increased, but also carbon followed that because that is the role of the instrument. Speculation has eased slightly, and of course, carbon remains a very technical market. Now, biggest drivers that we see in terms of the environmental market is the Fit for 55 plan by the European Commission, the Green Deal alongside that, and of course, all discussion around COP26. We do expect carbon to start being more volatile within the next couple of months as discussion around decarbonization start to pick up again. So it's a very interesting market to look. Of course, carbon has been just above 55 euros. Recently, we have seen yesterday a very significant drop, which means and kind of brings back questions around how much volatility we get from carbon. We do expect, as I said, carbon to start affecting the markets considerably just because of the policy changes that we expect to be announced over the next month or so. I think that's the end of the presentation, Lucy. If you go to the next slide. Well, thank you very much. Any questions similar to Damien, please feel free to send.
Thanks very much, Anas. I will now move on to the Q&A section of the webinar. We've had a few questions in already. If anything else comes up, feel free to pop them in the box. So the first one we've got here is for Anas. You've already touched on it a little bit, but why have we seen a drop in LNG imports, and is that expected to change?
So if we start back from the start of the year, LNG imports have started to drop just because there was lower availability. So we have seen maintenance mainly in the US that started affecting the market, but the main reason throughout 2021, specifically over the last few months, is because we have seen a higher demand from Asian markets. We have seen spot cargoes being basically picked up by Asian buyers, specifically in China and Japan, and we usually see these markets absorbing energy cargoes because they are paying more for these actually. So that is another reason why we've seen UK and European gas prices rising in order to follow that trend. And this is a very good question because it is a risk that we expect to have this winter. If we see high demand from Asia, we do expect LNG to flow towards that side, which actually makes up our markets much tighter. So we need to pay more to get the fuel in.
That's great, thank you, Anas. Another one here for Damien. Do you see further delays in the implementation of the Tariff reform beyond this winter? And again, I think you might have covered that in a bit of detail, but if you've got anything additional, that would be great.
No, I don't really. I think yeah, we're going to hear something before April. We're waiting for Offgem to make its decision on CMP 343, which was the consultation which looked at postponing implementation. So no news on that yet. I was on a call with Offgem and industry participants yesterday, and they didn't say when they were going to publish that, but I imagine it would be, you know, sort of I'd imagine it would be this quarter. So we'll just have to wait and see.
That's great, thank you. Another question here for Anas. Do the forecast price ranges for gas and electricity include some assumptions about outputs from COP26, or is there a risk of significant impact if agreements are made on carbon pricing, for example?
Yeah, that's a very good question. So we don't have assumptions on COP26. We do have we have included the assumptions, or not the assumptions, but the changes that we expect from the Green Deal, as well as the UK emission reduction targets that we already know. But we do expect to have volatility in the carbon market because of these announcements. We have seen the UK, of course, coming out yesterday just before COP26 to discuss about climate change, discuss about the plans to decarbonize further, and we have seen some sort of volatility coming in from this in the carbon market. So it is a very interesting COP this year, I think, just after COVID. Of course, a lot of countries have issues, and they have to actually look into the finances as well. So it's really interesting to kind of understand what is the drive, whether it has changed after COVID, whether of course we know climate change is there, but we have to see how much commitment we have from different countries. We have seen the UK being there quite strong, of course, hosting the event as well, but it's a very interesting question to be made around the Chinese targets, what the US will do, and all discussions. And I think if we get signals that there's not a global unity around it, then we might start seeing some sort of pressure on global carbon prices, which actually will lead to lower UK and EU prices, because as the EU has said in the past, they cannot help, alongside UK, they cannot decarbonize the world together. They need to have a unity around that, and China plays a big part into that. So we need to start seeing, I think, China being increasing commitment in that aspect. So I think, yeah, what's that space? I think it is very important to understand that.
Thank you. Another one here for you, Anas. How much is the new Norwegian power pipeline going to help the UK market? Is it expected to flow towards the UK mainly? Yes.
I think the answer is yes. It's going to help a lot, I think, because it brings mainly cheap power from Norway. As I said, hydro and renewable power, mainly from wind, is the two main elements in the Norwegian market. So we do expect to flow towards the UK most of the times. I think is a large in volume as well, and as many as possible pipelines you bring in, it actually reduces the impact of gas markets as well, because you directly get power from other markets. If you increase interconnection, you decrease volatility usually. So it's a very important pipeline to come in, especially this year.
Thank you. Damien, one here for you. How will the capacity market landscape change over the next few years to account for the increase in renewable generation and a drop in conventional power production?
Yeah, that's a very good question. I can answer that on a couple of levels. So the first one is to look at the fundamentals, the generation mix going forward. So the amount of generation which is going to be coming off by the middle of the decade. So we're looking at all those old nuclear plants coming offline, obviously coal exiting the mix going forward. I think bear in mind that with the capacity market, it's under constant review, and sort of BEIS launched a consultation, I think the other week, looking at ways of additional new technologies entering the market. So that is a route there for wind generators and other technologies as well. So but beyond that, it's also launched a consultation back in August, looking at aligning the capacity market with net zero targets. So yeah, sort of more wider ranging reform as well. But just to come back to the near term or the medium term outlook, yeah, we do have some challenges in terms of changing generation mix. That's obviously reflected in the price, the price of scarcity. So yeah, we would expect the auctions to clear at higher prices than they have done than the previous 5 years of the scheme's operation, and that's the market doing what the market does. So yeah, at the end of the day, consumers need the power, but they have to pay for it. So yeah, so a lot of changes in the future, I think. Yeah.
Definitely, that's great. Thanks, Damien. Another one here for you. Do you know a rough difference between fits within the winter and summer periods? How much load factors and cloud cover affects the figures?
Yeah, as you said, as we saw on that slide, there's a wide variation on a quarterly basis and between years in terms of the charge. So basically 80% of the portfolio is small scale solar generation. As we alluded to, if you get quite technical, you look at the number of sun hours. So this is a statistic that is published as part of BEIS's energy trends, which we look at, so you can compare the 10-year mean with subsequent or the years around it. Yeah, this year it was very cloudy summer. Well, wasn't a good summer as last year, so the number of sun hours, the amount of sunshine was a lot lower. But yeah, we had a price there, didn't we? Q2 20 of nearly £10 and about £6 this year. So for Q2, so obviously going into winter now, looking outside, it's overcast. Much lower amounts of solar being generated. So to come back to the other part of the question, we're looking at about 10% load factor across the year, but obviously that is going to change depending on what quarter you're in. So we could have actually lower costs this year if demand is much higher with the recovery. So charging base expands and the scheme costs are kept relatively low. That's going to reduce the unit rate for everybody.
Thank you, Damien. Just a couple more questions here. One for Anas. Why do we see a disconnection between carbon and gas/power prices in recent months? What is driving power prices at the moment?
Yeah, I think the main reason for the disconnection is because gas has came to the forefront. I think we've seen gas driving at the moment power prices. Gas is slightly almost driving carbon at the moment as well. So because of the tightness of the market, we have seen, of course, gas prices rising significantly, and carbon is following the rise in order to not leave other conventional generation come in, specifically coal and lignite, to be fair. At the same time, we have seen a significant drop in speculation over the last couple of months. Mainly because of the similar increase. We have seen a lot of suppliers of different market participants not being that active in the carbon market, if that makes sense. And of course, following all the announcements around the Green Deal, around the Fit for 55, we had expected anyway to start seeing a bit of a drop in the speculation side of things from the carbon market. Now, in terms of the second part of the question, what's driving power, I think it's almost purely gas at the moment, alongside renewable generation. I know I've said that quite a few times already, but it is mainly gas that is affecting the whole system at the moment. Is where we need to focus, is where we have most of the risk. Of course, ahead of winter, we need gas to actually generate power, of course, alongside heating. But you know, gas represents a good 30 to 40% of the UK system at the moment. So you can imagine that any volatility in that market will actually directly affect power. Now, carbon is included in the gas kind of equation anyway. We don't have much coal or lignite to burn in this country specifically, but what happens in the European market does affect the UK power prices and gas prices as well. So it's all a very well interconnected system. But to answer completely the question, I think at the moment, if I needed to give a percentage, I would say probably 80% gas, 20% carbon. But as I said earlier, with all the changes we expect in COP26, it's likely we start seeing a higher correlation between carbon and the rest of the markets, because carbon will start to get a bit more volatile as we move forward with all the announcements and everything else.
Great, thank you. And we've had a question just come in for you, Anas. Is there a sufficient pipeline of additional projects to meet potential PPA demand if soaring wholesale prices lead to more large consumers to pursue PPA deals to fix costs for the medium to long term?
Sorry, can you repeat the question? I apologize. I had a bit of a cut on the...
Yeah, sorry. So is there a sufficient pipeline of additional projects to meet potential PPA demand with the soaring wholesale prices to deal with the increase in interest?
Okay, yeah, so I mean, that question is pretty much where we fit what I'm doing now, but I think yes, there is a very significant pipeline coming on over the next few years. We have seen the UK government specifically focusing and targeting on offshore wind that we expect to actually meet a lot of the additional demand. We have to, of course, consider the aging fleet in terms of nuclear and gas and what is coming online, but we do expect to have a significant increase in renewable generation over the next few years, which will find its way either through schemes, government schemes, CFD specifically, or through corporate PPAs, which have seen a very significant increase in corporate PPA deals recently. Interest from both corporates and, of course, higher supply from generators. Now, in terms of how the market performs, we do see a correlation between the PPA deals and what the market is doing. But because the PPA market and what we see is usually a longer term deals that looks all way down towards 2035, 2040 sometimes. It's very significant to understand that they only have a small element of what is happening in the near term at the moment, and they're mainly looking on the long term. Now, of course, you would expect, as we start seeing more renewable generation in the system, for prices to start probably rationalize as we move forward. But gas will still play a big part, and it's probably where most of the volatility will come, because we have to think about that Asian markets are still very well into the conventional power generation, mainly coal and lignite. So to decarbonize, they need to make that transition towards gas first and then renewable generation, which even a smaller percentage in the UK market with gas will actually need to be under competition with these markets for the same volume. So yeah, just to again answer the question, we do see and expect a significant increase in renewable generation. Offshore wind is the focus at the moment, and we do see that being depicted into PPA deals. We have seen the PPA market rising significantly, specifically following COVID in 2020.
That's great. Thanks, Anas. So that wraps up all of the questions that we've had in. Lucy, if you wouldn't mind moving on to the final slide, there's just a couple of points that we wanted to finish on. So we wanted to take this moment to celebrate an award we were very excited to receive last week at the IWFM Impact Awards. This was in the category for positive climate action for our work with our Plan Zero project. So I'd like to send my congratulations to all the wider team. I know it was a great evening, and we're very excited to have been successful. And Lucy, if you wouldn't mind moving on to the final slide for me. Thank you. So if you'd like to hear more about this space and how we could support you, please do visit planzerocarbon.com, where you can access all of our latest materials, including our energy paper, with details about how you can make a no-risk energy service switch. You can also find out more and make inquiries on our new Plan Zero bolt-on services, which making deployment of decarbonisation services, including EV charging and solar PV, quick and simple for organisations. You'll also find information about our newly announced funding opportunities with SDCL, designed to help with large-scale decarbonisation. So I'd just like to take the opportunity to say thank you all for joining. We hope you found it useful, and we'll be circulating all of the slides and the recording after the webinar. Thank you very much, everyone.
Thank you, everyone.